Someone once asked me about how to invest, and they were wondering about how to get the best rates of return. So I'm going to share with you right now the #1 mutual fund that existed between January 1st of 2000 until December 31st of 2009, the 10 years of what many of us have called the lost decade. And I'll bet you that you'll be hitting yourselves, I wish I could have earned this. This was CGM Focus, run by a man named Ken Hebner. And Ken Hebner received all kinds of financial media accolades because he was able to return 22%. How many of us wish we could have had 22% rate of return? But someone really smart did an analysis of what the average investor earned. Negative 11%. That's net of fees, net of taxes, net of costs. He earned 22%, but the average investor only earned negative 11. That's a 33% swing. How can that possibly be? Well, I'm going to share that with you right now. And that's because math is not money. Now, let's just suppose I'm not financial genius, and I can guarantee you a 20% rate of return. How does that happen? Well, the first year, I'm up 100% because I'm such a genius. But the second year, something happened, I got stupid, and I lost 60%. Well, that leaves 40%. It was over 2 years, so we divide that by 2, and now we have a 20% rate of return. If I can guarantee you a 20% rate of return, folks, how many of you would want that? Pretty much all of us, right? Well, since math is not money, let's take a look at what that really means. Let's suppose we started with $1 million. And the first year I'm that genius, and I double it to $2 million. We go up 120%. The second year, though, I lose 60% because I took my eye off the ball. I've lost $1,200,000. That leaves me with only $800,000, which means I've had a $200,000 loss, and yet I had a 20% gain. And here's what's even worse. In order to make this $800,000 become $2 million again, I have to go up 150%. How hard do you suppose that would be? Remember, math is not money. Make great decisions.